A single $10,000 investment in the S&P 500 in 1980 grew to over $120 million today, and it required precisely zero effort. Most people spend their entire lives chasing the next big stock, the hot new crypto, or a secret side hustle. But the underlying math reveals a completely different, almost entirely ignored reality about how actual lasting millionaires are built in America. The real secret isn't finding the needle in the haystack, it's just buying the entire haystack and doing absolutely nothing. If you want the real story behind building quiet, lasting wealth without the hype, subscribe to the channel. Let's get into the actual mechanics of why boring, unglamorous investing consistently beats Wall Street's smartest traders over time. Picture two investors. Sarah day trades options trying to double her money, while John simply buys a broad index fund every month. Sarah might win big on a Tuesday, but the transaction fees and short-term capital gains taxes quietly erode her actual take-home returns. Meanwhile, John's portfolio looks exactly like watching paint dry, but it harnesses the single most powerful mathematical force in modern finance. Compounding means your historical returns automatically generate their own future returns. A reliable average gain doesn't just add money, it exponentially multiplies your base. Over 30 unbroken years, that simple boring math transforms a modest monthly contribution of $500 into a staggering $110 million retirement nest egg. The modern financial industry aggressively hates this lazy approach because they simply cannot charge you a massive management fee for doing absolutely nothing. Active fund managers are highly educated, well-paid professionals, yet over a 15-year time frame, more than 90% drastically fail to beat the basic market index. They are essentially charging you a massive premium to mathematically underperform the exact results you could easily achieve with a single, low-cost Vanguard fund. Let's examine the behavioral trap of market timing. Trying to brilliantly buy at the exact bottom and sell at the exact top sounds incredibly logical. However, the stock market's biggest single-day gains typically occur on highly unpredictable days, usually arriving directly after massive, terrifying, widely publicized market drops. If your fear causes you to miss just the 10 best trading days over a 20-year period, your overall historic returns are effectively cut in half. Boring investing completely removes human emotion from the equation. You automatically buy consistent shares whether the global headlines are dangerously euphoric or confidently predicting the apocalypse. This timeless strategy, widely known as dollar cost averaging, ensures you automatically acquire more total shares when prices are severely depressed and fewer when they are expensive. Consider the brutal historic crash of 2008. The benchmark S&P 500 quickly lost half its value, terrifying millions of average people into selling at the absolute worst moment. But those remarkable investors who blindly held on and kept their automated monthly contributions running saw their quiet portfolios completely recover and then impressively quadruple over the next decade. The real persistent challenge of this path isn't the underlying math, it is the sheer psychological endurance required to endlessly endure the aggressively mundane nature of the process. Human beings are biologically wired for immediate action. When the market violently drops, our primal survival instincts literally scream at us to do something quickly to protect ourselves. But in authentic wealth building, sudden action is usually the enemy. The objectively most successful, high-performing portfolios often belong to everyday people who literally forgot they even had them. Internal Fidelity research famously highlighted that their absolute best-performing individual retail accounts consistently belonged to ordinary investors who were either physically deceased or simply completely inactive for decades. That striking internal data point is the ultimate structural proof that permanently leaving your accumulated money alone is vastly mathematically superior to constantly tinkering with your current asset allocation. Furthermore, a boring investing lifestyle permanently frees up your single most valuable, entirely non-renewable asset, your daily time. You frankly never need to read confusing corporate earnings reports again. Instead of anxiously staring at flickering red and green portfolio candles, you can completely focus your raw energy on increasing your primary career income or genuinely enjoying your everyday life. The true ultimate goal of acquiring money isn't to unintentionally create a highly stressful, unpaid second job managing it. The genuine goal is securing absolute lifelong freedom and profound peace. By automating your excess capital into broad, diversified, low-cost index funds, you methodically construct a financial fortress that slowly but entirely unstoppably compounds silently in the background. Imagine checking your portfolio only twice a year. It sounds completely reckless, but it is actually your greatest advantage. A legendary internal performance review at Fidelity once revealed their most successful accounts belonged to people who were either dead or had forgotten they had money. Why does this happen? Because complete inactivity perfectly prevents the single greatest destroyer of modern wealth, emotional trading. When the stock market drops 20%, your primitive brain screams at you to sell everything and hide in cash. That exact instinct kept our ancestors alive when facing predators, but it absolutely slaughters your portfolio during a temporary correction. Let's analyze the S&P 500 over any rolling 20-year period in modern American history. The data is shocking. Despite world wars, severe recessions, and global panics, the historical success rate of a 20-year continuous hold is practically perfect. But if you actively try to dodge the bad days, the compounding math turns against you with ruthless efficiency. Between 2003 and 2022, missing just the 10 best days in the market literally cut your overall returns in half. Here is the brutal statistical irony: those best market days almost always happen immediately after the absolute worst panic days. By selling your shares during a panic to feel safe, you permanently lock in your losses and miss the inevitable recovery. True wealth compounding doesn't look like a glamorous rocket ship, it actually behaves much more like a slow, crushing glacier. It moves slowly, almost invisibly on a daily basis, but it carries enough unrelenting mass to carve out entire mountains. Consider a simple $500 monthly investment injected into a low-cost, broad market index fund yielding a historical 8% average. For the first 5 agonizing years, the growth feels painfully slow and almost entirely dependent on your own direct contributions. You diligently deposit $30,000 and your total account balance sits around $36,000. It certainly doesn't feel like financial freedom yet. However, as the decades pass, compounding math subtly shifts the heavy lifting away from your wallet and onto the market. By year 20, your portfolio crosses $290,000, and surprisingly, more than half of that money is pure, unearned compound growth. Fast forward to year 30, and that boring glacier finally becomes an unstoppable financial avalanche worth over $740,000. Your original lifetime contribution was only $180,000. The broad market handed you over $500,000 simply for waiting patiently. This is the quiet, unglamorous magic of automatic dividend reinvestment and compound interest working relentlessly while you are asleep. Wall Street absolutely hates this passive approach because they cannot legally charge you a hefty management fee for doing nothing. Every single time you trade a hot stock, a broker collects a transaction fee. When you sit still, you keep the profits. The financial entertainment industry spends billions convincing you that profitable investing must be complex, highly active, and endlessly exciting. They aggressively push algorithmic trading courses and exotic crypto platforms specifically to drain your capital through 1,000 tiny cuts. Real generational wealth is built by cheaply buying the entire economic haystack instead of endlessly hunting for the speculative needle. Owning a tiny fraction of 500 highly profitable companies means you are placing a permanent bet on the upward march of human progress. You absolutely do not need a genius IQ to succeed here. You simply need a high tolerance for boredom and an iron stomach. Boring means mathematically predictable. Boring means incredibly low stress, and historically boring remains the most reliable path to a millionaire net worth. So stop treating your retirement account like a casino. Buy the index, turn off the financial news, and let time do the heavy lifting. Consider what happens when you automate a simple $500 monthly transfer into a total market index fund. Over 20 years, the actual cash you contribute is just $120,000, but the math of compounding tells a completely different story. Thanks to dividend reinvestment and average market growth, that mundane routine balloons to over $350,000. This silent accumulation happens entirely in the background while you sleep, work, and live your life. You aren't checking charts or timing market swings. The mechanism here is the compound annual growth rate, historically hovering around 10% for US equities. It takes the heavy lifting completely out of your hands. Compare this to active trading, where professionals spend 80 hours a week analyzing charts. The SPIVA scorecard shows over 90% of active managers underperform over 15 years. If Wall Street experts with supercomputers cannot consistently beat the average, trying to do it from your smartphone is a statistically losing battle. This brings us to the hidden tax of excitement. High-frequency trading generates friction through fees, capital gains taxes, and constant emotional stress. Every time you buy or sell a trendy stock, you trigger a taxable event. Those short-term capital gains taxes can eat up to 37% of your profits immediately. Boring investing defers that tax burden indefinitely. By holding your index funds for decades, your capital grows without the constant drag of the IRS taking a cut. Warren Buffett famously won a $1 million bet by proving a simple Vanguard S&P 500 index fund would outperform a basket of elite hedge funds over a decade. His strategy was the definition of unglamorous. He literally did nothing for 10 years, allowing the top 500 American companies to simply run their businesses and generate profits. When you own the index, you own the entire capitalist engine. You employ the brightest minds at Apple, Microsoft, and Amazon to work tirelessly for your net worth. If one sector of the economy struggles, another inevitably steps up to pull the weight. This internal self-cleansing mechanism protects your wealth from catastrophic single-company failures. You might miss out on the thrill of catching the next big tech unicorn early, but you also completely eliminate the risk of your portfolio going to absolute zero. Think of your portfolio like watching paint dry, or growing an oak tree. The daily progress is entirely invisible to the naked eye, yet the structural growth is relentless. During the 2008 financial crisis, the market dropped 50%. Investors who panicked and sold locked in massive, permanent losses that derailed their retirement plans entirely. But those who embraced the boredom simply kept their automated contributions running. They ended up buying shares at a historic discount, supercharging their recovery when markets rebounded. This is the psychological advantage of an unglamorous strategy. When your portfolio requires zero daily maintenance, you completely remove the emotional panic that destroys most retail investors. The real secret of the wealthy isn't finding a hidden, exclusive investment vehicle. It is having the extraordinary discipline to execute an ordinary plan for 3 consecutive decades. Let's break down the sheer mechanical power of dividend reinvestment. When a company pays you a dividend, using it to buy more shares creates an exponential feedback loop. In 1990, a $10,000 investment in the broad market yielded a tiny annual dividend. Today, the dividends alone on that same investment would exceed your original principal. You are literally being paid a growing salary just for holding an asset. This passive income stream eventually becomes large enough to replace your entire working paycheck. The financial media hates this approach because boredom doesn't generate clicks or sell advertising space. They need you to feel anxious about impending economic doom every single day. If the news told you to simply buy a target date fund and ignore the market for 40 years, financial networks would go bankrupt overnight. Their business model relies on your constant agitation and movement. Your wealth building model relies on absolute stillness and letting time do the heavy lifting for you. Consider the concept of the behavioral gap. This is the difference between the return of a mutual fund and the actual return earned by the average investor in it. Morningstar research shows this gap costs investors roughly 1 to 2% every year. People consistently buy when markets are expensive and sell when they are cheap. By committing to a rigid, boring strategy, you instantly close that behavioral gap. You force yourself to buy consistently across all market cycles regardless of the headlines. This concept is known as dollar cost averaging. It smooths out the chaotic volatility of the stock market and turns market crashes into predictable buying opportunities. But the ultimate benefit of this slow wealth approach is time freedom. You reclaim thousands of hours you would have wasted stressing over charts and financial news. Consider the standard broad market index fund, the ultimate boring financial vehicle. It systematically purges corporate losers and adds rising winners without you lifting a finger. Contrast that with actively managing a stressed portfolio of 30 individual stocks. You are suddenly fighting an exhausting daily war against market efficiency and trading fees. Independent industry research consistently shows that over a 15-year period, nearly 90% of actively managed mutual funds completely failed to beat their benchmark indexes. That massive 90% failure rate isn't because Wall Street lacks incredibly smart people. It happens because the simple math of high fees destroys compounding returns. Imagine paying a 2% management fee annually on a large retirement portfolio that slowly drains tens of thousands of dollars over 2 long investing decades. A total market index fund, however, might charge a tiny fraction of 1%. The massive difference stays right in your account, silently multiplying your wealth. This is the true invisible engine of lasting wealth creation. You aren't just saving money, you are literally buying back entire decades of future personal freedom. But the mainstream financial media absolutely hates this simple approach. A boring headline reading "Stay the course and do nothing" doesn't generate clicks or sell advertisements. Major financial news networks thrive on constant panic, urgent alerts, and the terrifying illusion that you must act right now to safely protect your hard-earned money. Reacting to that manufactured daily urgency is how ordinary investors sabotage their own returns, locking in permanent cash losses during every single temporary market correction. In 2008, terrified people who panicked and sold their portfolios entirely missed out on the longest bull market in American financial history. Those wise investors who did absolutely nothing and during the temporary pain saw their wealth fully recover and multiply significantly over the next 10 long years. Doing absolutely nothing is remarkably difficult when everyone around you is screaming that the sky is falling. It requires profound emotional maturity and intense psychological discipline. This brings us to the crucial foundational concept of complete automation. Removing the flawed human element from your investment process is your strongest defense against yourself. Set up automatic electronic bank transfers so that the fixed cash amount automatically moves from your checking to your brokerage account every single payday. This powerful strategy, known as dollar cost averaging, automatically ensures you buy more shares when prices drop and fewer shares when markets hit all-time highs. You no longer need to nervously predict whether the stock market will crash tomorrow. You are systematically buying the entire American economy completely on autopilot. Consider the profound daily peace of mind that comes directly with this. You permanently reclaim the countless hours previously wasted staring at stressful daily stock charts. Time is your only truly non-renewable human resource. Spending it obsessing over unpredictable daily market fluctuations is a genuinely terrible trade for your mental health. Instead, you let the collective brilliant innovation of thousands of publicly traded companies work tirelessly every single day to increase the underlying value of your shares. When Apple invents a revolutionary new product or Microsoft improves its cloud services, your diversified index fund captures that real economic growth entirely automatically. You never need to nervously pick the single winning horse when you simply own the entire global racetrack. The fundamental math virtually guarantees your long-term success. Even during difficult periods of uncomfortably high inflation, broad U.S. equities have historically been one of the absolute most reliable ways to preserve your vital purchasing power. Strong, resilient companies simply raise their prices to adjust for inflation, which eventually translates directly into higher nominal corporate earnings and steadily growing dividend cash payouts. Reinvesting those regular quarterly dividends is the absolute secret fuel for your wealth engine. It rapidly accelerates your compounding curve, especially during frustrating flat market decades. This deliberately unglamorous cycle of earning, saving, investing, and blindly reinvesting is the exact financial blueprint used by nearly every self-made millionaire in America today. It completely lacks the dangerous adrenaline rush of day trading crypto or chasing volatile meme stocks, but adrenaline has absolutely no real place in serious wealth building. If you desperately want thrilling excitement, take a few $100s to Las Vegas. If you want true generational wealth, embrace the extreme boredom of consistent index investing. The ultimate financial luxury isn't a flashy depreciating sports car bought with leveraged debt. It is the quiet inner confidence of knowing your financial future is completely secure. As your automated retirement portfolio eventually crosses the $1 million mark, the daily market fluctuations become entirely irrelevant background noise against your massive compounded capital base. Wall Street sells complexity because complexity justifies expensive fees. Your broker isn't pitching a simple index fund because there is no massive commission in it for them. Every time you buy or sell a hot stock, friction eats your returns. Those tiny trading costs and bid-ask spreads quietly drain your portfolio balance over time. Add short-term capital gains taxes to the mix and the government takes a huge slice of your rapid-fire profits. Active trading mathematically forces you to underperform. True compounding requires uninterrupted time to work its absolute magic. When you constantly tinker with your portfolio, you reset the compounding clock back to zero every single time. Consider the S&P 500, historically returning around 10% annually. It never actually delivers exactly 10% in any given 12-month period, which confuses amateur investors. You will face brutal years where the market drops 20% or more. This volatility is not a penalty, it is simply the admission price for long-term wealth. During the 2008 financial crisis, panicked investors locked in devastating permanent losses. Those who simply did nothing and held their boring index funds eventually recovered every single dollar. Missing just the 10 best days in the market over a decade crushes your overall return. You cannot predict these explosive days, so you must remain fully invested. Market timing is a seductive illusion that bankrupts smart people. It requires you to be right twice, knowing exactly when to sell and exactly when to buy back. Human emotion always pushes us to buy high and sell low. A boring strategy removes dopamine from the equation, forcing logic to override your natural primal panic. Automating a monthly $500 transfer into a total market fund requires zero daily effort. This mechanical habit guarantees you acquire more shares whenever prices inevitably drop. Dollar cost averaging turns market crashes into your greatest wealth building opportunities. You stop fearing red days because you are systematically buying solid companies on clearance. A boring portfolio feels slow, but it acts like an unstoppable glacier. Over 20 years it carves out massive financial security while everyone else is chasing exhausting trends. Warren Buffett famously bet $1 million that a basic index fund would beat elite hedge funds over 10 years. The boring strategy crushed the expensive experts effortlessly. Highly paid Wall Street managers consistently fail to beat the broader market over long horizons. Their complex strategies look sophisticated, but the math reveals chronic long-term underperformance. Simplicity is the ultimate sophistication in personal finance. A 3-fund portfolio covering domestic stocks, international equities, and bonds is all the diversification most investors will ever need. Rebalancing once a year forces you to trim winners and buy losers automatically. It is the only reliable way to manage risk without attempting to predict the future. You must completely ignore financial news networks designed to trigger daily anxiety. Their entire business model relies on keeping you terrified, so you watch through the commercial breaks. Fear generates massive television ratings, but boredom actually builds lasting generational wealth. Turning off the financial noise is the most profitable decision you can make today. True financial independence means shifting your focus from daily stock charts to decades of steady accumulation. You stop playing the casino game and become the house itself. Wealth creation is a marathon played over 3 or 4 decades. If your investing strategy feels exciting or adrenaline-fueled, you are probably doing something incredibly wrong. In the first 10 years, your own contributions drive most of your portfolio growth. It feels painfully slow, and many people quit before the math gets truly fascinating. By year 15, the interest earned on your previous interest begins to dwarf your monthly deposits. The snowball effect finally takes over, accelerating your net worth exponentially. A 20-year horizon changes everything about how you view temporary economic recessions. Short-term market crashes become irrelevant blips on your long-term trajectory toward total financial freedom. Getting rich slowly is the only reliable method that actually works for normal people. It requires zero inside information, no unique genius, and absolutely no reckless leverage. We have been conditioned to believe that high effort equals high reward. In the stock market, doing absolutely nothing is often the most mathematically optimal choice available. Your greatest financial edge is your capacity for profound patience. While institutional traders fight over daily pennies, you are quietly capturing the massive economic progress of humanity. Leave the flashy crypto trades and leveraged options to the internet gamblers. Embrace the dull certainty of owning productive global assets through low-cost funds. When your money works quietly in the background, you reclaim your daily attention. You buy back your time today while simultaneously securing your absolute freedom for tomorrow. The path to a multi-million-dollar retirement is astonishingly unglamorous. It is built entirely on the quiet, uncelebrated discipline of buying, holding, and never interrupting compounding. Real wealth isn't built on adrenaline, it's built on the quiet, persistent accumulation of assets that compound while you sleep, totally ignoring the noise. Think of it like planting an oak tree. You don't dig up the acorn every Tuesday to check its progress, you let time and nature do the heavy lifting. The media sells you chaos because panic generates clicks and trading fees. But your brokerage account doesn't care about the 24-hour news cycle. Historically, the S&P 500 has rewarded patience with a 10% average annual return. That means every $10,000 invested can double roughly every 7 years. Yet, the average investor vastly underperforms that benchmark. Why? Because they flinch during downturns, selling low to stop the pain and buying back high. Boring investing removes that emotional tax. By setting up automatic, recurring contributions to low-cost index funds, you literally engineer human error out of the equation. You are paying yourself first, systematically buying shares whether the market is roaring or crashing. Over decades, this dollar cost averaging builds an unstoppable financial fortress. This isn't theoretical. Look at everyday workers who quietly reached $1 million in net worth just by consistently funding their retirement accounts over a 30-year career. The true cost of chasing the next hot stock is the guaranteed compound interest you sacrifice. Complexity is often just a disguised way to separate you from your cash. So, embrace the boredom. The ultimate luxury of a simple portfolio is that it frees up your most valuable non-renewable resource, your time. When you stop obsessing over ticker symbols, you can focus on your career, your family, and the life you are actually saving all this money for. We promise to show you how ordinary people build extraordinary wealth. The real answer is simply time, strict discipline, and a profound tolerance for doing absolutely nothing. Like this video if you prefer peace over panic. Subscribe and comment your favorite index fund below. Next time we reveal why your savings account is secretly making you poorer.